Hello, welcome listeners and market participants, and thank you for joining KBRA's European Credit Podcast, Conversations in European Credit. I am Gordon Kerr, Head of European Research at KBRA, and today I am joined by a number of my colleagues from the European Ratings team. Welcome, Ken Egan from our Sovereigns team.
Hey, Gordon. Thanks for having me.
And thank you for joining us, Callie Siraguti from our RMBS team.
Hi, Gordon and everyone.
And thank you for joining us, Caitlin Perella from our CMBS team.
Hi, everyone. Thanks for having me.
Today, we will be covering the topic of our expectations for 2024 in European securitization markets. Will 2024 bring us an economic soft landing or a hard one? Will interest rates remain high, or will an economic slowdown cause central banks to begin cutting rates? Many key elements are improving each day, with inflation rates slowing and unemployment remaining low, but many other signals are suggesting a slowdown ahead. Next year looks to be a bumpy ride as central bankers and governments navigate the coming turbulence. For European securitization markets, continued collateral performance deterioration is likely in 2024 as borrowers in some sectors begin to feel the impact of current conditions. On the other side, the funding environment has changed to bolster securitization issuance. With the European Central Bank and the Bank of England stepping back from bank funding support, this should support a growth in issuance in 2024. In this first of two podcasts covering the outlook for European securitization markets in the year ahead, we will be covering the European economic environment as well as the residential mortgage-backed securities and commercial mortgage-backed securities perspectives.
So let's start with Ken Egan from our Sovereigns team. Ken, the fight on inflation is likely to be won in 2024, but this also likely means a slowdown in the economy. What are your views with regards to inflation in 2024?
I think there are a lot of different aspects to inflation in the euro area at the moment. Yes, it's true, inflation is now roughly back to or even below target for many sovereigns, for example, the Netherlands, Italy. But many are experiencing sticky prices in services in Spain, France, Portugal, for example, and getting back to target is a bit trickier. But ultimately, yes, as the liquidity in the market continues to dry up and monetary policy action we've seen this year, which typically acts at a lag, starts to feed through, it will continue to take the sting out of price growth. Governments are also trying to balance their books, so no more deficit spending. Like, for instance, they are winding down or ending their inflation shields and cost of living supports. Loan growth has also contracted massively. So overall, there's less credit in the system. And of course, energy prices have stabilized, and we see this big base effect from last year. However, a more longer term view would suggest that there still are significant inflationary pressures. Demographics, labor supply, wages, which are turning from nominal growth to real growth, all place upward pressure on prices. Energy is another one to watch, as there have been structural changes in Europe. The big supplier is now out of the market, and now we have competition for LNG gas deals and a push to get terminals online. Futures prices suggest oil and gas will trade above their historical norms over the medium term. So while that volatility might have been removed this year, the input cost of energy could remain high. Final point I'd make on inflation regards expectations. And for both the euro area and the UK, medium-term outlook, if you take the five-year, for example, it shows consumers and businesses expecting inflation above target over the period, well above target in the case of the UK. On the demand side then, the government shields in place in many countries have shaved several percentage points off inflation. Those will be coming to an end. In some sovereigns like France, for example, you still have high household savings underpinning consumption, which might hold up better than expected, helping growth, especially if the purchasing power of households gets a boost from wages. Across the euro area, generally, trade is having a big impact on growth. It seems to be a link to the sluggish Chinese recovery. So on the one hand, domestic demand might have got a helping hand from fiscal support in the euro area, but external demand outside the bloc is lacking. The manufacturing and this industrial outlook remains weak.
Thanks for that, Ken. One of the supporting elements, at least in terms of the European securitization market, has been the ongoing levels of strong employment. What are your perspectives with regards to the employment picture as we head into 2024?
I think we are slowly seeing the impact of this new interest rate environment starting to feed through. You could see weakening investment, higher defaults, and pressure on firms and their margins, ultimately hindering expansion and could reduce the need for labour. I think you can already see this materialise somewhat in the vacancy rate and the unemployment rate across the euro area. So the vacancy rate in the euro area has moved marginally lower, although it remains high from a historical perspective. And this, coupled with the slow move higher of unemployment rates across the bloc, is a sign that monetary policy is starting to bite. And I'd expect this trend to gradually continue next year. I would say that when you take a step back and look at the wider context, we still view the labour markets in Europe as tight and struggling with supply issues. The labour force could not keep pace with the demand in the market after the strong recovery in 2021 and 2022. Tied to this, early retirement through the COVID pandemic, upskilling amongst workers as evidenced by the decline in the underemployment rate, and a slowdown of migration to Europe and changing demographics are all factors influencing supply within the labour market. Again, similar to the inflation cycle, there are more structural challenges facing the labour market in the euro area. But right now, we are seeing the impact interest rates are having on demand, and this is moderately loosening the labour market.
Okay, with that information, how do you see the development then of interest rates over the course of the year? I mean, will rate cuts happen later or sooner? And what about the differentiation between the UK and Europe?
I don't think the market likes higher rates and is maybe moving aggressively to force policymakers' hand early next year. Maybe the ECB and BOE will act more cautiously. For sure, some policymakers could be wary that they've overcooked it, but some could also be wary of a resurgence of inflation from the pressures we outlined earlier. Right now, markets are expecting several cuts for Europe next year, starting pretty early on too. The UK is a bit different. It's a bit slower, largely due to its own pressurized inflation dynamics tied to things like the impact of Brexit, the level of tightness in the labour market, which has led to more pronounced wage growth. The degree to which the markets start to price in cuts for the UK could be later in the year.
I guess just to point out, the longer term view does underpin that higher for longer narrative we heard through much of last year. For example, if you look at certain borrowing rates like the OIS forwards, you can see that 1 month borrowing starting in 5 years' time in the UK has a rate of 3%, and in the euro area, it's 2.2%. Similarly, Euribor futures still around 2.5% out to 2029. This marks a big change from recent years where rates were close to or below zero. Policymakers have been at pains to highlight how data dependent they will be going forward. So you could maybe say that there could be some volatility with regards to the timing of rate cuts, given the uncertainty of some data points.
Great. Thank you very much for that, Ken. That sets a very interesting backdrop as we now turn to the European securitization markets. And first of all, we will speak to Kali Siraguti on the residential mortgage-backed securities market. Kali, as we heard from Ken, rates may start to decline in 2024, but maybe not quite so rapidly or quite so far as some may expect. What does this mean for mortgage borrowers?
Thank you, Gordon. And before I answer that question directly, just a bit of the background on the mortgage performance, the way we've seen it changing during this period of increasing interest rates. So the increasing interest rate environment has had varying effects on mortgage performance to date. I'm sure it's not lost on any of the listeners who are active in the RMBS space and mortgage performance so far. The performance has varied by jurisdiction and asset class, whether prime, non-confirming, buy-to-let, or reperforming mortgage loans. While delinquencies have increased in general, particularly in jurisdictions where mortgage borrowers pay a variable rate of interest or have remortgaged to higher short-term fixed rate interest rates, like in the UK, a meaningfully high proportion of borrowers have shown resilience to higher repayments on account of the higher interest rates. Now, this could be an account of the savings from the COVID period, or simply tightening the belt on household expenses, prioritizing mortgage repayments. Now, given this background, stability of interest rates at the current levels is a big plus to households without any further increases in 2024, a decline in interest rates would be welcome for all mortgage borrowers without doubt, but may not mean that mortgage delinquencies decline as quickly as they rose. Now, KBRA expects delinquencies to increase further in 2024, stabilize, and decline only over an 18 to 24 months period.
Thank you, Kali. Now, the RMBS market contains several different sub-markets or sectors. Which areas of the RMBS market are you most concerned about in 2024?
Non-confirming and the RPL performance in the UK and Ireland demonstrate increasing average delinquencies. Now, these sectors are leading indicators of financial stress felt by mortgage holders, as majority of the loans are originated pre-GFC and contain a variable rate of interest. Now, delinquencies in Ireland, non-confirming and RPL pools have increased to 25% in June 2023 from the lows of 9% in September 2019. Now, if you then shift the focus to buy-to-let performance, specifically in the UK, Ireland, and Netherlands, so that performance also demonstrates vulnerability to increasing interest rates, despite the trend of rising private residential rents. Rents have been increasing at a rate of 9% in Ireland, 6% in the UK, and 2% in the Netherlands. And notwithstanding that, the buy-to-let performance certainly is affected adversely to a degree. And that's because landlord borrowers have not been able to revise rents to match the pace of interest rate increases. In Ireland specifically, you have rental caps. So landlords that have large portfolios of rental properties have borne the higher repayments more easily compared to individual or small landlords. And if you look at some of the recent trends which you see in UK and Ireland, KBRA expects that the exodus of small or individual buy-to-let landlords from the buy-to-let sector in the UK, particularly, and of course, as observed in Ireland, will continue as buy-to-let yields have fallen. So that's specifically around those subsectors where the performance has been relatively more adverse as compared to, for example, the prime. And in general, a rise in mortgage defaults and losses are contingent upon a rise in unemployment if the current high interest rates lead to a recessionary environment across jurisdictions.
Thank you, Kali. That was very interesting. The house prices are obviously a major part of the RMBS market. We are not necessarily house price forecasters, but do you have any major views about the directions of house prices in 2024?
So house prices in the UK and some EU jurisdictions have recently declined. The largest declines in the past year have been in Germany, Denmark, and Sweden at 10% or less. Prices have declined by 1.8% on average across the euro area, a 3.1% decrease observed in the UK. And these are driven by a decline in demand for house purchases, and mortgages at the higher interest rates have largely become unaffordable to many first-time buyers. Declines have been somewhat moderated by opportunistic purchases of properties by cash buyers and long-standing supply constraints. So in comparison, some of the markets have continued to show positive house price growth, such as Portugal, Poland, and Spain. Ireland, as regards the house price growth, has seen a slowdown and continues to see improved demand for house purchases. Affordability has held up well, as mortgage interest rates have not increased at the same pace as the increase in the ECB rate. So Ireland's house prices are also supported by low supply of new housing, and monthly mortgage payments, and even at the current high interest rates, are relatively lower in comparison to a rented home. What you've seen in Germany in terms of the decline in house prices by 9.9% has been driven by a rise in mortgage rates and increasing construction costs, causing demand to dry up, which has pushed some developers into insolvency. So the outlook for house prices across Europe in 2024 are anticipated to remain under pressure, as demand will struggle to return given expected high near-term interest rates. Now, further, bank risk appetites will likely limit mortgage availability with the prospect of slowing growth. But on a positive note, the house price growth over the pandemic period has placed house prices in a position to weather further declines and limit losses in mortgage portfolios.
Great. Thank you very much, Kali. Now, turning to you, Caitlin, the commercial real estate market has been one of the first markets to be heavily impacted by rate rises. Where do we see yields migrating in 2024?
Thanks, Gordon. So property yields after bottoming out in 2021 have continued to increase over the last 2 years across all property types and jurisdictions. However, the velocity of the increase has generally decreased over 2023. If central bank rate hikes flatten in 2024, as anticipated, property yields should begin to plateau, which would bring us more stability to property valuations in the coming year.
One of the major concerns for this market is the challenges around upcoming maturities and the ability for borrowers to refinance. What is your perspective on this for commercial real estate broadly and CMBS markets in particular?
The current interest rate environment presents challenges to CRE borrowers seeking to refinance loans with near-term final maturity dates. Most European CMBS loans are floating rate, and UK and Eurozone interest rates are at their highest levels since the onset of the global financial crisis. As borrowers navigate the elevated interest rate environment, we expect to see them utilizing pre-existing loan extension options, which are common in European CMBS loans. However, borrowers typically must enter hedging on commensurate terms, and in most instances, strike rates are significantly below current reference rates, increasing the cost to extend the interest rate hedges. There have been several instances where the servicer has allowed the borrower to amend the hedge strike rate upwards due to market conditions, something that may become more common in 2024. In addition, we may see loan sponsors with final maturities in the coming year request final maturity extensions to allow time for market conditions to improve. Depending on the transaction terms, the servicer may be allowed to make this amendment. Otherwise, the note holders will have to vote to extend the loan past its final maturity. Other loan modification requests and equity injections are also more likely in the future, as borrowers face lower valuations and subsequently higher LTVs and lower interest coverage ratios.
Thank you. What sectors of the real estate and CMBS market do you see as being the most challenged in 2024?
Generally, real estate property performance will face challenges as borrowers continue to deal with the elevated inflation and secular trends. But we do think that offices are going to experience the most turbulent period through 2024. This sector has been notably impacted by remote work trends and a flight to higher quality assets. Vacancies across all major cities in Europe have generally been increasing since 2020, which highlights the uncertainty surrounding this asset class. Newly constructed assets next to transport hubs that have environmental certification are better positioned to capture the reduced demand, while older, less strategically located and ill-configured buildings will need a significant amount of capital expenditure to be competitive once again. We expect to see older offices, especially in secondary locations, continue to underperform in 2024.
Thank you very much, all. As you have heard, the market appears to be in a transition, both in terms of economies as well as collateral performance across the sectors that we cover here at KBRA. With rates high and likely to remain so in the near term, borrowers will continue to be squeezed at the start of the year. This will challenge performance in many different securitization markets, such as reperforming loans and buy-to-let, as you heard from Kali. And the CMBS refinancing environment will also be challenged, as highlighted by Caitlin. On the positive side, low unemployment levels, strong underwriting quality, and skilled servicing should help to keep performance from deteriorating greatly across securitization markets. You can find greater detail in the report published on our website. Be sure to listen to our next podcast, where you will hear more on the ABS and structured credit markets. Please make sure you don't miss a thing by registering to receive our latest commentaries and subscribe to our podcast. Be sure to give us a review, and of course, please reach out and engage with our experienced analysts. Thank you very much for listening. We look forward to bringing you more conversations in European credit. We all hope you have had a great holidays as we prepare for what is shaping up to be a turbulent year ahead.